Australia may not be in a recession, but you wouldn't know it from the latest business investment numbers. Investment plunged more than 9% in the September quarter, a worse deterioration than during the last recession. It had the economists downgrading their growth forecasts and underlines the pressure on Treasurer Scott Morrison to abandon the tough budget talk. Here's finance correspondent Philip Lasker.
When interest rates aren't working where they're supposed to, there's always Plan B.
We embrace the future with enormous optimism.
Manufacturer Ron Weinzel is taking that approach, but much of his manufacturing business comes from making components for sectors that rely largely on government spending, like defence, aerospace and health. He's ramping up investment with the help of a $1 million government grant.
We wouldn't have been able to afford to do the investment if we hadn't have got the support from government.
But other parts of his business exposed to the consumer sector aren't as strong.
The correction that we had since the GFC, I think people have sort of looked at that and all the social media that tell you what's going on around the world. Yeah, there's not really any confidence. I'm hoping that the current government will start to put some really good structures in place.
The September quarter collapse in business investment of 9.2% is the biggest fall on record and 3 times more than the forecast deterioration. Expected investment for this year also continued to fall away.
The mining capex cliff, we are well and truly over it, and there's a bit more to come still.
As expected, the mining investment freefall accounted for most of the decline. But the disappointment came from services sector investment, which was supposed to soften the blow from mining. But it also took a hit.
What's worrying is that spending plans for 2015-16 remain very underwhelming. They're still pointing to a drop in overall expenditure.
Today's numbers had most economists downgrading their growth forecasts, so there won't be any talk of budget emergencies from Treasurer Scott Morrison when he unveils the mid-year economic and fiscal outlook next month.
The current Treasurer doesn't have to do anything dramatic to get the budget back into surplus sometime over the next 5 to 6 years. But what he does have to do is he has to balance a set of conflicting objectives. That being a softer economy now, the need to essentially chart a path back to surplus.
The trajectory for the budget's actually looking okay. And that's mainly because expenses are down compared to what they thought they might be.
It's not as impressive as it might look because some spending was pulled forward into the previous fiscal year. And the government also received a fairly healthy dividend from the Reserve Bank.
One thing perhaps that does worry me a little bit is the fact that revenue has been softer as well as expenses being softer. Now, if you see a continuation of that trend, then clearly it becomes harder to get to the end target.
The government's budget projections have been downgraded from 3 to 2.75%, a cost to the budget of around $50 billion over the next decade.
What we should be doing now is doing everything we can to instil confidence in businesses and in households to get all that money that seems to be hiding under pillows out into the real economy, investing in the next Facebook or, for example, big infrastructure projects.
The government's task won't be helped if the property market loses too much momentum next year, as some predict.
We might see that impact through the wealth effect. In other words, people not feeling quite as wealthy, therefore they don't go out and spend quite so much money. And the other thing, of course, is that the Australian dollar's depreciated around about 25–30% since its peak. We don't expect that rate of depreciation to continue.
All the more reason for Scott Morrison to nurture the optimism Malcolm Turnbull is attempting to foster through what's likely to be a pre-election budget.
We are now in a sort of a sub-trend situation. It seems like we'll stay there if all things remain the same. The big thing that might change is a global downturn made in China. Right now, the Chinese authorities have their hands full with all sorts of domestic issues.
You set that on top of a soft domestic economy and potentially you're looking at a real downturn.